Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is Sean O'Hara, President at Pacer ETFs. Pacer offers 46 ETFs listed here in the US with about 16 billion in total assets under management. They offer some very interesting strategies like Cash Cow, Trendpilot that have significantly outperformed the broader indexes this year and have also seen very impressive growth in assets despite these market headwinds. Sean, welcome back. Great to have you on the show.
Well, thanks, Nina, for having me back. It's my pleasure.
So today is another day of wild swings in the market. And as we are talking, and for the purpose of reference, we are talking in the afternoon of Thursday, October the 13th. So stocks plunged this morning after another hot inflation report, and then they had a major turnaround. But apart from these wild swings, this has been a very challenging year for investors, with almost all major asset classes down significantly, leaving very few places to hide for investors. So I wanted to start with your thoughts on the recent market action and what lies ahead in your view.
Well, I mean, it's kind of, you said, that the market plunged. Actually, futures were up this morning first about 1%. Then the inflation number came out, then the market plunged, and then it went back up. So I think, we're in one of those periods where you're going to probably see some of this happen until, some of these bigger picture items get worked out. The big drag on the market so far year to date has been the Fed and their steadfast approach at raising rates, which, by the way, on a historical basis, faster than I think they've ever done that. Usually it takes them several years to raise rates as much as they have this year in a tightening cycle. And rampant sort of out of control inflation. And when you have those two factors in play at the same time, normal market PEs you see market PE compression, and so we've seen quite a bit of that. We may not have seen all of that. There may be some more to go, but it's a very reactive market, and it's hard to explain. Sometimes the day-to-day swings. The bigger picture is that until the Fed is satisfied that they've done what they need to do to raise rates high enough to sort of curb the inflation problem, and when we see whether or not that had a mild or a medium or a really bad effect on the overall economy and then ultimately corporate earnings, we won't really know directionally where the market's going. So in that environment, I think it probably is more prudent to be more defensive than aggressive. Although, we see, a news item come out, like Australia's central bank, indicating they were going to raise, less than they did. And everybody saw that as a sign that all the central banks had followed with a big swing up, and then it turned out not to be the case. Then we saw the UK government, intervene and reverse their quantitative tightening program and starting quantitative easing, and everybody thought that's what's going to happen, and so the market sort of spiked on that, and then in reality that really wasn't what's going on. So I think we're in sort of a period where we're going to see some real volatility, and the thing to keep an eye on if you're an investor is really a couple of things. One is is the tightening cycle that the Fed's involved in right now, is it having an effect on reducing inflation, or is it just simply driving up potentially the unemployment numbers, which that may make them change course. And so we need to know that. And then, we're at the beginning of an earnings reporting season here. And so you sort of have to watch for guidance. Guidance is what's going to be most important. And it wouldn't surprise me that, like some of these companies would just sort of have like a kitchen sink approach to getting all the bad news out of the way while we're in this potential cycle. So it's a tough environment, and we have had the good fortune at Pacer ETFs of having several strategies hold up really well during that are primarily equity strategies. So we feel pretty lucky, and we have a lot of empathy for the investors and financial advisors as they deal with what may be one of the more difficult times that they've ever dealt with, because both stocks and bonds are down this year.
So let's talk about some of those strategies that have done quite well this year. And particularly, I wanted to start with your cash cow series of ETFs. So before we discuss those ETFs, which have seen very significant investor interest this year, a lot of inflows, let's start with why investors should focus on companies with high levels of free cash flow.
Yeah, I mean, that's a great question. So the COWZ series uses a formula called free cash flow yield to determine whether we would include a stock in our index or not. We screen a lot of broad indexes for the 100 stocks with the highest free cash flow yield. And free cash flow yield is the free cash flow a company generates divided by its enterprise value. And enterprise value is just market cap plus debt minus cash. So it's just a simple formula of how much do I have to pay in total to buy the whole company? How much cash do I get back every year as a result of that? You divide one into the other and it gives you a yield. Our argument is that the higher that free cash flow yield is, the cheaper the stock is relative to others. It's important for two different cycles in terms of mindset, long-term and short-term. So let's talk about short-term to start with. Well, when you have a Fed that is tightening and raising interest rates, and when you have inflation, both of those things are negative for future growth. And so, that's why I think so far year-to-date growth has struggled. The opposite of that is true when you use free cash flow and free cash flow yield as your screening mechanism, because essentially you're getting a very high current cash return on your investable dollars. So I don't have to discount the money I might get back in terms of earnings if I'm investing in a growth stock. I'm actually getting paid a very attractive amount of money in terms of free cash flow as a percentage of the total enterprise value today. So I have less of a discounting mechanism. And so that's one of the reasons it's held up, I think, so well. The longer term story there is that we think it's a solution that might be better suited to solving the traditional value, traditional value way of investing. That has predominantly been on using low price to book as the mechanism. And in this environment where there's essentially very little tangible book value left in the stock market, most of the stock market's market value is intangible assets. There's something like 90%. And so when there's no tangible book value to look at and measure like a traditional value person would, you have to find a different way to identify what's cheap. And our argument is that if you use free cash flow and free cash flow yield as the way to identify stocks that are cheap relative to their peers, that makes more sense in a world where you can't rely on the old traditional price to book approach. So longer term, although we're really pleased with the performance this year, of the COWZ series relative to the broad markets, we're even more excited about the opportunity to have discussions with investors about sort of redefining what traditional value looks like.
That's very interesting. And let's talk a little bit more about the most popular, the biggest ETF in the cash cow family. It is the Pacer US Cash COWZ 100 ETF. The ticker symbol, very interesting, is COWZ, COWZ. So this has taken in almost $7 billion this year. Very impressive. And I'm looking at the performance. It is down less than 8% this year, whereas the broader S&P 500 index is down almost 25%. So tell us a little bit more about this ETF, the weighting methodology, and then we can talk a little bit more about the current sector exposure in the ETF and maybe some of the top holdings.
Yeah, so the process for COWZ is we license the Russell 1000 value from FTSE Russell. And we build a custom index out of that, using that as the sort of the base index to select securities. They're all large cap stocks. And so what we do is we screen that index for the stocks that have the 100 stocks that have the highest free cash flow yield. There's two exceptions. We eliminate financials in our screening process, not because we don't like them, but because you can't really screen a financial on a free cash flow yield basis. And two, we eliminate any stocks in the Russell 1000 that have projected negative net earnings going forward. So from that remaining list, we pick the 100 stocks with the highest free cash flow yield, and then we weight them not by market cap, but we weight them by the free cash flow they generate, and we cap every name at 2%, and we rebalance on a quarterly basis. And so as we get ready to discuss the sector allocations, the sector allocations can change fairly rapidly because of that 90-day rebalancing. And so you'll see things move around quite a bit. Like right now, we're overweight energy and healthcare and materials. They probably comprise somewhere in the neighborhood of like 55% of the weight of the portfolio, maybe slightly higher than that. But if you looked 2 years ago at the portfolio holdings, we would have had very, very little energy exposure. We would have been underweight materials. Healthcare would have been probably an equal weight, and we would have been overweight, for example, technology and the consumer discretionary names. So what we own in the portfolio is just a simple factor of what that screen gives us. And so we wind up owning sort of higher quality companies that are giving us a high current return on our cash invested through this free cash flow yield mechanism. They tend to pay dividends and pay attractive dividends, and they tend to be in a position where they can support the increase in their dividends. And oftentimes they're pretty aggressive names in terms of buying back their own company stock. So it's a pretty robust strategy, and things rotate from time to time. If I looked back 2 years ago, we would have been, like I said, overweight technology would have been our biggest weight at over 30% at the time. But because of the way the market has moved and because of the way free cash flow has changed from sector to sector, we're now overweight energy and healthcare materials.
Right. So I'm looking at the sector breakdown. And as you mentioned, energy is currently 29% of the portfolio. And then healthcare is just about 23%, second highest weight, and makes a lot of sense because these oil companies, they have been generating a lot of cash and also returning a lot of cash to shareholders. So that's why the ETF has a very juicy dividend yield as well. And the top holdings, Regeneron, Marathon Petroleum, ConocoPhillips, ExxonMobil, these are among the top holdings in this ETF. Now, you also have a global version of the Cash Cow ETF. It is the Pacer Global Cash Cow Dividend ETF. The ticker symbol is GCOW. This has also done well and seen a lot of investor interest. But before we talk about the ETF, I was just interested in your thoughts on investing in markets outside the US currently, because we know that the US economy is slowing down, but the economic conditions outside the US are much worse. And that is mainly due to the impact of Russia-Ukraine war, and which resulted in an energy crisis in Europe. And then there's the impact of COVID lockdowns in China, and most importantly, the impact of surging US dollar on international markets. So what are your thoughts on investing in global markets outside in the US particular currently?
Well, it's been challenging to say the least. Maybe not too much more challenging than the U.S. because it's been a brutal year in terms of stock market returns here. But typically investors who run diversified portfolios will always have a certain portion of their portfolio allocated to non-U.S. equity holdings. And so our view would be if you're going to do that in this environment, something like GCOW, which uses basically the same approach that COWZ does, but with an emphasis on selecting high dividend payers. You can buy international stocks or global stocks with GCOW at really almost once in a lifetime valuations. I think the PE on GCOW is under 6 times earnings, and the free cash flow yield currently is somewhere in the 13 or 14% range, and the current dividend I think is right around 6 or maybe slightly higher. So as a way to stay allocated in a responsible, diversified portfolio and owning non-U.S. names, we'd rather do that in this environment than buy the broad markets over there where you're basically owning everything that's in an index. And, as you look further across the globe on international, emerging markets have been, again, really a tough place to be, mostly because the dollar is so strong. And the dollar is so strong mostly because our Fed policy here driving up rates, making people want to buy U.S. government securities, but also because the price of oil and the dollar are fairly closely linked, and so that sort of is what made it's made the dollar one of the strongest global currencies. And so that hurts emerging markets, but like on a historical basis, if you had 5 years or longer to invest, you would have an opportunity internationally between GCOW or ICOW, which is just pure large cap, all international, or even ECOW, which is the emerging markets version of COWZ, to buy those strategies at unbelievably low overall valuations with tremendously high free cash flow yields. Like ECOW right now, again, trades at like 6 times earnings, but the free cash flow yield on the names we own is over 20%. That means that those companies, essentially, if they wanted to, could essentially buy all their stock back and retire all their debt with their free cash flow in a period of time as short as 5 years. That's what a 20% free cash flow yield means. So you're getting a historical opportunity if you have the guts to be allocated internationally in a market where overall they're beaten down, but by using the free cash flow and free cash flow yield methodology, do it in a way where you're not paying a high PE or even a market PE, and where you're getting a much higher current return on your investable dollars.
Yeah, I agree with you. The valuations look really, really compelling, and for long-term focused investors, it does make sense to take a look at international markets and emerging markets as well. So we talked about GCOW and ECOW. You also have a small cap version, which another very interesting ticker symbol COWZ. And then you have a fund of funds. The ticker symbol is HERD. Tell us a little bit about COWZ and HERD.
Well, I mean, of course, if you're going to have a small cap cash cows strategy and your large cap ticker is COWZ, it makes sense, right, to have the small cap ticker be CALF, a little baby cow. In small cap land, again, historically, small cap value over time has been the best performing asset class amongst the different ways to invest: large cap, mid cap, small cap, growth or value or blend. So again, you have an asset category that has historically provided really historically high returns that's been beaten down. And on CAF, the same thing's true. We pay a very low multiple relative to the broad market. We own a 100 stock portfolio that generates a huge amount of free cash flow, double digits in the case of CAF. And again, for people who are concerned about risk, small caps are really unique in a couple of ways. Two things to keep in mind. One is in all the broad small cap indexes, like call it the Russell 2000 or the S&P 600, which is what we use, a big percentage of those names in those indexes don't make money. Like somewhere in the neighborhood of 30% or so of small cap names don't make money. And so we certainly don't want to own those, right? And then secondarily, small cap stocks tend to be more highly levered than large cap stocks, because they're borrowing to grow. They're borrowing money to become mid cap stocks first, and then hopefully large cap stocks as they grow up, right? And a lot of the debt that these small cap names have on their balance sheet is really 90-day paper. It's typically a bank loan type of a financing where you're paying a spread over a global benchmark like LIBOR, for example. And so as rates rise, the financing cost in small cap land goes up. And so having healthy small cap stocks that generate a higher amount of free cash flow than their peers and have a higher free cash flow yield means you're owning a portfolio with CAF of 100 small cap stocks that are all profitable and that have enough free cash flow to absorb the potentially higher financing costs that the Fed policy is going to cause on all those small cap names. And then we built a fund of funds version as a way for investors to just simply say, I just want to allocate to all of them in one ticker. And so if you have a whole bunch of cows together, obviously you got to call that a herd. And so that's why we use the ticker HERD. But essentially, you're getting access to large cap, small cap, global, international, and emerging markets all in one ticker that's automatically rebalanced on a quarterly basis. And so you can solve for that whole sleeve, if you will, of your value exposure by adding one ticker.
Okay, let's move on to your Trendpilot family of ETFs now. And your BTLC ETF has also seen a lot of interest this year. We'll talk a little bit more about this ETF in a bit. But before that, could you walk us through the Trendpilot, the trend following strategy, what exactly it aims to do?
Yeah, it's fairly simple, Nina. I mean, people have been using moving averages as sort of entry and exit points on a technical basis to take positions or to reduce positions. And so the 200-day moving average is something that investors have used for decades, if you will. And so what we simply do is we apply a 200-day moving average strategy to a broad-based index. In PTLC's case, it's the S&P 500. And essentially, when the S&P 500 is above its 200-day moving average, it would indicate it's in a positive trend. And historically speaking, that would be a good time to own. And when it falls below its moving average, it means that the trend is turned negative. And historically, that would be a sign for somebody who's a technical investor to sort of pull back or reallocate or take some of the risk off the table. And so we do this in an ETF. And over time, the goal is pretty simple. It's to be in the market as much as possible when the trend is positive, and to be in treasury bills as much as possible when the trend is negative. And when you have these bull and bear market cycles, oftentimes, one of the challenges investors face is that when you go through a bear market cycle, you got to ride it all the way to the bottom, and then you got to come all the way off the bottom and go back up. And if it's a normal bear market cycle, it's, say 2 to 4 years to go from peak to trough back to peak, it's tough to hang in there. And so what Trendpilot would do is at some point it would just simply say the index has fallen enough so that it's below its moving average. We're just going to sit in T-bills until things change and until the index goes back above its moving average. So as you mentioned, it's been gathering some assets. We think it's a good solid part of a portfolio for somebody who wants to have equity exposure but doesn't want all their equity exposure to stay long in the market. And right now PTLC is sitting in T-bills because the indicators we use, the 200-day moving average, for example, told us earlier this year we should be in T-bills. And so those investors are down about 8% or so year to date, compared to 23 or 24 or maybe even 25% on the S&P 500. And in the meantime, they're getting T-bill rates. So the Fed raising rates, which is causing the problem on the equity side, is actually a benefit for those investors, because right now T-bills yield north of 3%. And so it's actually not a bad part of a complementary position to a portfolio that would own, say, the S&P 500 or something like an S&P 500 ETF like SPY or IVB. So we like to teach financial advisors how to position PTLC in a portfolio for investors who are a little more conservative or who are more concerned about how much the market might go down. So if you added PTLC to your traditional long-only portfolio of U.S. large-cap equities, you would be adding a measure of downside risk management that it's very difficult to find other places.
So you mentioned that PTLC is currently in 100% T-bills allocation. Has that been the case most of this year?
Yeah, well, it's down 8%. So probably somewhere in the middle of the second quarter or towards the end of the first quarter, I guess we went to 100% T-bill position.
Okay. Now, another strategy I wanted to talk about is your Alternator series, and the one which I looked at is the Pacer Lunt Large Cap Alternative ETF, ALTL. Tell us about this strategy, which I understand rotates between high beta and low volatility stocks.
Yeah, so most investors are familiar with the S&P 500, or at least somewhat familiar. And what most people who are not, sort of full-time investors or investment advisors or in this business don't know is that S&P offers many versions of the S&P 500. You can buy pieces of it. The most common way to do that would be to buy sectors, for example. So you can buy the energy sector, a healthcare sector, or whatever. So you don't have to buy all 500 stocks. But what S&P also has is two indexes that we like to use in this strategy. One is a high beta index, which is the 100 stocks with the highest beta. And then there's a low volatility index called the low vol index, which is the 100 stocks in the S&P 500 had the lowest volatility. And we use a relative strength screen to determine which one of those two baskets, those 100 stock baskets, we would own at any given point in time. We run the screen every month. Sometimes the screen says to stay where we are, but oftentimes it'll say to shift positions from low vol to high beta, or from high beta back to low volatility. And the track record on the live track record on that ETF has been pretty remarkable. It actually has been beating the S&P 500. It beats the low vol index by itself just by owning low vol all the time. It also beats the high beta index if you just own that all the time. And so factors are an interesting way to invest, and over time they can produce higher returns, but they don't consistently do that. So if you owned low volatility over a long period of time, for example, you might outperform the market, but you'd go through sometimes prolonged periods of time where you would underperform it. So it's tough for people to hang in there. What this does is, by using that rotation or alternating strategy, is it moves you away from low vol when it's out of favor on a relative strength basis and into high beta, and vice versa. And so we've been really pleased, not only with the performance of the ETF since we launched it or since we really reorganized it out of another trust a couple of years ago. We've been not only, impressed with the performance. I think it's almost doubled the S&P's return. But we've also been very, very pleased with the asset growth, because there's a lot of investors who have been traditionally single factor investors who see this as a better way to be a factor investor. Don't stay wedded to one factor. Have a strategy that will move you from one factor to the other as the market dictates.
So I'm looking at the top holdings: at sea, Norwegian Cruise Lines, Royal Caribbean. These are among the top holdings currently. And what is the weighting scheme in this ETF? Is this almost...
They use beta as the weighting scheme. So this is, an S&P 500 index that we use. So we don't have control of the names. They do.
Okay.
And they construct that 100 stock basket. It's the 100 stocks with the lowest beta. And I believe they're using beta as a way to weight it, and same thing's true for the low vol index. It's the 100 stocks with the lowest volatility, and similarly.
Okay, excellent stuff. That's all we have time for today. Sean, thank you so much for joining us, and congratulations on the success of your ETF strategy in a very challenging year.
Well, thanks so much, Nina. It's always great to talk to you. We really appreciate the opportunity to have an in-depth conversation about what's going on at Pacer ETFs, and you've always been kind enough to let us have that audience from time to time, so we appreciate that.
So that was Sean O'Hara from Pacer ETFs. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.